now that we've had some idea of how this year is likely to play out, how do we take advantage of this new information that we have? Well, there's something that SGX introduced not long ago that you might find very interesting indeed. And to tell you more about that, I'm going to hand you over to the Director of Research for Equities at SGX, Mr. Lionel Lin, and he'll be with two of the very best finance educators in Singapore. Over to you, Lionel.
Hey, thanks so much, Edward. Very good morning, everyone, and happy Saturday. My name's Lionel. I'm from the research team at Singapore Exchange. I will be your moderator for this session today, and indeed, we are very excited to be able to discuss a very topical subject in this part of the world with everyone today. Special purpose acquisition companies, or SPACs, if you haven't heard about it already. Like Edward mentioned, we have with us two very distinguished guests and friends, Mr. Benjamin Goh and Mr. Gerald Wong, who have been very, very active in terms of investor outreach in this space since the start of the year. So really just a brief background on both gentlemen. Mr. Benjamin Goh, CFA, is Head of Research and Investor Education at Securities Investors Association Singapore, SIAS, an investor activist non-profit organization focused on investor advocacy. In his previous lives, Ben has held diverse roles in Vina Capital, Copper Basin Capital, CIMB Securities, JP Morgan, Credit Suisse, and Deloitte Consulting. Ben is a CFA charter holder and holds master's degree in both data science, AI, and finance. Moving on to Mr. Gerald Wong. Mr. Gerald Wong, CFA, is the founder and CEO of Beansprout, Singapore's next generation investment advisory platform, licensed by the MAS. He has more than 13 years of experience in investment advisory and was previously the head of Singapore Securities Research at Credit Suisse. Gerald was ranked top Singapore research analyst by a survey institutional investor between the period 2016 to 2020. And you might have seen him on making frequent media appearances in the Financial Times, Economist, BT, Straits Times, Lianhe Zaobao, and Channel News Asia. Gerald graduated from London School of Economics with an economics degree and acts as an industry mentor in the CFA Singapore Research Challenge. So really very, very well diverse background from both gentlemen. I would like to give a really quick, brief recap for everyone on SPACs. So obviously it's been 2 months since the first SGX listed SPACs. And as we have seen, the first batch has been led by very experienced and quality sponsors, and they have helped to make SPACs as a debut as a new asset class on the SGX. In fact, I think if you look at the demand, we have seen strong demand from both institutional and retail investors. We have seen oversubscription for the various IPO tranches, and we have also seen participation from cornerstone investors. So one thing to remind everyone here really is, while SPACs trade like securities, they are very unique with their distinctive life cycle and key milestones that investors should take note of. In fact, earlier this month, I just wanted to remind everyone again, the 3 listed SPACs have gone through the first key milestone, where SPACs units detach into SPACs shares and warrants, and now they are traded individually. So while we eagerly await the sponsors' announcement sometime in the near future on their proposed target acquisition, it is a very, very good time now to seek input from our 2 guests, right, on SPACs as an investment opportunity. So like mentioned earlier, both guests very active and in the midst of the SPACs action past couple of months. So perhaps like to give each of you a very quick time summary, right, to share some observations you have seen so far on this new product from your vantage point. So with that, we'd love to start with you, Gerald. So perhaps you can take this.
Okay, thanks, Lionel, and good morning, everyone who has joined us in the session this morning. Also, thanks to Singapore Trading Festival for having Beansprout at this event. So for Beansprout, we have always been wanting to provide our users with customized investment insights so that they can make better investment decisions. We have been quite active in terms of engaging our community on the SPACs over the last few months, whether is it through the SGX Academy webinars that have been held, or various community outreach events on our Telegram, Instagram groups. I think one very interesting feature is that the amount of interest that we saw in Singapore SPACs has been much larger than what we initially expected. This could potentially have come through from a lot of the unique characteristics of SPACs that we can discuss in more detail later. But more importantly, also a lot of the different trading strategies that comes through from SPACs. Given that this is a Singapore trading festival, hopefully we can discuss some of these different trading strategies with the audience today. And I think that is something that has really excited the community about the opportunities that have come through from SPACs.
Right, Benjamin, over to you, perhaps.
Hi, very warm welcome. Very good morning to everybody. I'm still waiting for Gerald to send me his Beansprout t-shirt. I think that's quite spiffy, actually. So from the SIAS angle, we certainly have been getting a lot of interest, as Gerald has mentioned. I think there is, I guess, some uncertainty and confusion as to how SPACs works. How SPACs work. Simply because there are various off ramps. You can redeem the shares, you can sell it. The warrants are detachable. How are they going to be detachable, so on and so forth. Certainly, a investment vehicle that is actually quite different from the usual stocks, bonds, CFDs, so on and so forth. That is popular on the Singapore Stock Exchange. So I think this is kind of like the beginning of the SPACs educational journey. Doesn't help that these SPACs have not gone through the de-SPAC exercise yet. So that's the next exciting part of the journey. I think everybody is getting ready for that. So certainly echoing what Gerald has mentioned, a lot of interest as well as I guess people wanting to know more.
Right. Thanks so much, Benjamin. Perhaps we can stay on with you, and with that, I would like to jump straight to the questions. Like we all mentioned, there's very key and unique features that SPACs do have. So obviously, I think they also bring some form of benefits to participants in the ecosystem. So perhaps, can you share with everyone what kind of benefits you think SPACs as a new asset class bring to the stakeholders for SPACs in the SPAC ecosystem, namely, your sponsors, target companies, and obviously, most importantly, the investors.
Sure. So from a kind of a zooming out macro overview perspective, SPACs is really a vehicle to bring more of a private equity investment style to retail investors. So traditionally, if you want to invest in private companies, look for good private companies to invest in. You can put your money with a private equity investment fund. Now, the challenge is obviously PE funds are not open to retail investors. Generally, they're open to accredited investors, which would be high net worth individuals, institutional clients, so forth. But the SPAC investment vehicle has got the same investment strategy. You have got a sponsor that needs to have a deep expertise in that particular sector. Go look for a potentially fantastic company which has not gone public. Invest in it at a very early stage phase before it gets listed, and then bring it to market. So that kind of investment style and the techniques and skill sets required are really part and parcel of the PE world. But now, as a vehicle, SPACs is now listed on the Singapore Stock Exchange, and that is very much accessible to retail investors. So that's the key, I guess, value add from a investment vehicle's perspective.
Right. Thanks, Ben. Perhaps, Gerald, maybe something for you to add on from your perspective.
Sure. I think the increasing popularity of SPACs as a listing vehicle can be reflected in the numbers. So if you were to look at, say, not in the Singapore market, but in the US, the number of listings that went through the SPAC route, then in 2021, that actually reached a record high and exceeded the number of listings that went through the traditional IPO route. This is really a reflection of a few different things that we have better quality sponsors. We have got the increasing recognition of SPACs as a vehicle that can be a way for companies to be listed. So I think the question then is, how is this being replicated in the Singapore market? We have seen the initial listings coming through in Singapore. We have got different protection mechanisms for users and retail investors compared to the US market. So this would include things like your redemption feature, where the holders of the SPAC can potentially get some of their capital back if they decide to not hold on the SPAC through the entire process. It'll be things like the voting rights that are available to retail investors who can decide whether or not they want to go ahead with the target company that the sponsors have selected. So all of this is actually coming through to effectively make SPACs as one of the options where sponsors can choose to be potentially looking at companies to acquire. It can be another asset class that retail investors can hold as part of their portfolios.
Thanks, Gerald. It's very comprehensive here. Staying on with you, really, on that note, SGX SPAC framework, obviously from our viewpoint, right, framework seeks to balance the interests for both sponsors and investors. So maybe you can just elaborate. I believe you shared a little bit over there previously. So maybe you can just elaborate and share a little bit on your thoughts around this, about the robustness of the framework and how it seeks to balance interests.
So I think it's not an easy job having to balance the interests of different stakeholders. But I think it is something that we can actually manage well and be able to spur good quality sponsors to be wanting to list in Singapore, but at the same time, making sure that retail investors have sufficient safeguards such that they feel confident investing in SPACs in Singapore. So I guess the balance is really making sure that the regulatory requirements are not too punitive for the sponsors, but then at the same time ensuring that the retail investors have sufficient safeguards. So one example I would say would be the requirement for the SPAC sponsors to hold a certain amount of the IPO capital in an escrow account. So for those who are not familiar with what an escrow account is, this is effectively a third-party account. The sponsors are not able to touch the money except for certain expenses that may be incurred. And in this case, in Singapore, the requirement is 90%. It is a very high level, but in certain cases, we actually see that the SPAC sponsors actually go above and beyond that, even offering 100% of the capital being put in this escrow account. So I would say that is one of the particular safeguards that is in place where there are sufficient level of protection for retail investors. But interestingly, it would seem like the SPAC sponsors are very keen to be able to offer the retail investors such protection such that the interests would appear to be aligned.
Hey, thanks, Gerald. Over to you, Ben. Really, our framework, like I mentioned earlier, seeks to find that balance. It's never perfect, but we'll try the best for the whole ecosystem, right? Really, perhaps you can share a little bit on the framework in terms of the alignment of interest between sponsors and investors, particularly the sponsor skin in the game, and how, at least from our perspective, right, is sort of like a leveling the playing field between the sponsors and investors, and maybe some additional thoughts on the framework.
Sure. So I guess the challenge here is to be able to offer the sponsors enough upside to be able to get into this business. Get into this business, as well as to spend the time, effort, as well as the perhaps bear the reputational risk of taking a SPAC to public and then looking for a good target company to buy. So that can come in a couple of ways. So you have got, as you mentioned just now, skin in the game. So that is the equity participation. So the sponsor will have to buy between 2.5% to 3.5% of the number of SPAC IPO shares. This is on the same at the same price as everybody else. So this is generally, I guess you can think of it as the war chest for the sponsor to have some funds to run the day-to-day expenses of the SPAC itself. And that, of course, will be the investment bankers, the lawyers, so on and so forth. And they need to start looking for a target company, right? Now that is not really the upside that a sponsor is gunning for, because it's just, you know, keeps the lights on. So the other part would be the promote, yeah. So the promote is defined as you know, the additional SPAC IPO shares that the sponsor can buy at zero or nominal consideration. In other words, at zero cost or very low cost, and that is up to 20% of the SPAC IPO shares on a fully diluted basis. Now, this is what we call the upside, right? So it also aligns the interests of the sponsor as well as the other shareholders, because obviously, if the sponsor has got a relatively significant share ownership of the SPAC IPO shares, then you know, hopefully the sponsor will you know, work towards making sure that the de-SPAC process is a great success. So I guess the wish list is that the sponsor can find the next Tesla or Facebook or Google when it's worth about 100 million Sing dollar, and then buy it early on, own 100%, and then, you know, 10 years later, we all ride off into the sunset with a Bentley or a Ferrari. So that is the great dream, and of course, to make sure that the sponsor actually does their work for us as, you know, shareholders, we need to give them something, and that's where the promote comes in. So the flip side is that we don't want again too many sponsors that come in and say, you know, they can do this, and then they get the 20% promote, and at the end of the day, you know, we get really a lackluster kind of performance, and that's why we also have got the governance structure, right? So you have got the moratorium on the sponsors' shares. They cannot exit until after 6 months, you know, 6 months after the de-SPAC process. If they want to vote for or against the de-SPAC process, it's only limited to the equity participation, which is the 2.5%, 3.5%. They can't use the sponsors promote part of it to vote for the de-SPAC process. There is an off-ramp, as Gerald has mentioned just now. You can redeem your shares. You can also sell your IPO shares in the open market. You can detach it from your warrants and trade it separately, so on and so forth. So all those are the kind of like safety net or off ramps that is offered to Singapore retail investors when they invest in SPAC. So I think it's kind of a good balance. We want to make sure that the sponsors do the work they are supposed to do, give them enough incentive, but we can also get out if we think that the sponsors are completely rubbish. Right. So I think it's a good balance.
Right. Thanks, Ben. I think it's good. Also, just wanted to share some background for that. The SPAC framework was launched in September last year, and I think we've seen one of the highest ever responses for our consult paper. So obviously, a lot of you from the marketplace, and yeah, I think it's a framework that we came out with, which we hope to be able to balance the interest out there. So yeah, to shift gear a little, we always speak about SPACs as an alternative asset class. I think Gerald, in some of your education series, you have mentioned about them, right? So really a question to start with you first. How do we investors view them as compared to traditional PE or VC funds? Understand Benjamin previously said earlier, the barriers of entries to PE and VC funds, right, is quite high for retail investors like you and I. But for example, how can SPACs really complement, really take on the role of a traditional PE or VC fund? And how, from a asset allocation standpoint, right? Obviously, CFA charter holders here, right? Well, maybe you can just share with us how we can position them as part of our asset allocation.
Sure. So I think if you were to think about basic asset allocation, one fundamental that everyone would probably be aware of is the strategy around diversification. So I think where SPACs actually come in here is when we have one additional asset class that we can potentially think about, then the options around diversification become more significant. We already have very popular asset classes such as the REITs in the Singapore market. So with SPACs actually coming in, we can think about how they actually fit within our investment objectives, our risk appetite, such that we are able to structure our portfolios better. So you're right to say that there is effectively now an opportunity to invest in some of these high growth companies that might potentially be only available to some of the PE or VC funds previously. But one point that we can potentially think of here is also in terms of the opportunity cost. So one of the things about SPACs is that it might actually take time for the sponsors to be looking for a target company. So apart from the objectives around your investment appetite, your risk objectives, the time horizon aspect is also another thing that comes into play here, because the SPACs in Singapore have up to 24 months to be finding a target. This can be extended for another 12 months subject to certain requirements and the approvals. So this is actually a time where your money is sitting there. Yes, it is actually put in the escrow account, but we also need to think about whether we want to be having the capital in this SPAC, while there could be other investment opportunities in the Singapore market, in overseas markets. I think those are all questions that we can think about and maybe discuss in more detail when thinking about the trading strategies.
Thank you, Gerald. Anything from your side, Benjamin, to add on?
Sure. Yeah. So I'm glad that Gerald touched on the REITs as I guess as asset class or sector. You see, REITs are very popular simply because they are dividend plays. So a large segment of the retail investors kind of like that. So apart from making money when the stock price goes up, that sometimes can be a bit volatile. Having a nice dividend yield consistently over the next few years is actually quite nice. Can't be said. The same can't be said for SPACs. So when you buy into the SPAC at the IPO, basically you might end up being locked up for 24 or 36 months. Generally, the price should not move too high away from the IPO price, and I think the IPO price for all the 3 SPACs listed right now is $5 per share. So it shouldn't move up to, it's not going to be $15 or it's not going to be 50 cents, simply because it's a cash company. So there's no business, there's no cash flow revenue. Really, it's just about the expenses related to finding a good target company to buy, and there's no dividends, right? So that is absolutely only I guess people who want to buy into a SPAC should be I guess aware that they might have to wait until 36 months to actually see some kind of return. So it's absolutely not for the dividend investing clientele out there or people who want to have a quick win. All right, so you want to have a quick win, you can always look at something called Bitcoin. I think that's a bit interesting. Yeah, but that's a subject for a different day. Yeah.
Sure. Thank you. Yes, I think one key point you mentioned is about the opportunity cost, right? In terms of funds, rather than deploying in SPACs right now, we don't know for sure when they will acquire. They announce the acquisition, so your funds may be tied up for a period of time. Yeah. Shifting gear, obviously earlier on in this conversation, we speak a lot about sponsors really being the key pillar to the success of SPACs, right? Maybe a question for Gerald, for you, right? How important do you think sponsors play a role in terms of creating value and driving shareholders' returns for the target company post the completion of the acquisition? And this is especially true for sponsors with a very, very vast and also deep network. Yeah, so I think we've seen some of the sponsors talk about it, using their ecosystem to help potential companies, target companies grow. So maybe, just some comments over there, if you will.
So for us, the sponsor is probably one of the most important factors, if not the most important factor, when evaluating a SPAC before it acquires a company, because effectively a SPAC acts as a blank check company with the sole purpose of acquiring another operating company. We do not know what is the company that it is going to acquire. All we know is really the sponsor's track record, what are the sectors that they are looking to acquire from. And the best analysis that we can potentially be doing is around what we believe the sponsor is able to bring onto the table. So some of the things that we often suggest people to look at would be whether they have the domain knowledge in the industry that they are operating in, because this will allow them to analyze whether there are good quality companies in this industry and which are the companies that offer long-term growth opportunities. The other factor is whether they have the experience in being able to acquire companies or whether they have the experience in operating and running a SPAC. So this is where their M&A capabilities, their corporate experience will come in useful, since it is an exercise that requires all of the skill sets to come into practice. The last factor is really whether they have sufficient alignment of interest. So Ben mentioned earlier about having sufficient skin in the game. So based on how the SPAC is actually structured, we can actually see whether their interests are aligned, because as retail investors, that is what we want the SPAC sponsors to be doing, so that we can trust them to be finding good quality companies to acquire.
Hey, thanks, Gerald. That's very helpful. Yes, definitely a very important role for sponsors. Benjamin, you mentioned about the cap on promote. Would love to hear your views on sponsors. How do you see them?
So the other thing that I could just add is that when a SPAC goes through an IPO when it's first listed, they are under no obligation to kind of state what kind of company they're going to acquire at the end, nor do they need to state what kind of sector the target company might be in. So we can get hints from knowing who the sponsor is. So if you look at the sponsors of the 3 SPACs already listed, you look at the deals that they've done previously or their current portfolio companies, which means that some of the companies that they already have some small stake in, that might give you a hint as to what the sponsors might be looking at. Right. So are they looking at transportation? Are they looking at tech or biotech or fintech or I don't know, climate, called clean energy, sustainable energy, so on and so forth. So there's a lot of ambiguity because sponsors, they don't have to say anything. Obviously, they can't until they have identified a target company and they want to, organize a shareholder meeting to vote for or against. So up to that point in time, we really don't know. But I guess we can always look at what the sponsors have done in the history, right? So not going to name names, but as you can see, some of the sponsors are very heavy into technology. So I guess the wish list is that they can find the next Google before it goes public.
Yes, thanks, Ben. Yes, track record and also executional track record in the past, right? Obviously, can help us form a little bit of opinion on the potential companies or sectors they're going to look into. Staying on with you, really. If you look through the prospectus of all 3 SPACs, right, that's really a key focus on, say, your APAC, high growth tech, and also industrial companies as a key area. Obviously, the sponsors have put it very broad in terms of the number of sectors out there, right? Like you mentioned earlier, fintech, health tech, prop tech, etc. At least from your area, right, in your day-to-day, within Asia, where do you see the biggest opportunities within these numerous sub-verticals for tech? Yeah, just wanted to hear a little bit from your perspective.
I guess it really depends on what sector of technology is. So if you look at the popular companies technology-wise, would be things like Deliveroo or what you call Ninja Van, so on and so forth. Not to say that those are going to be the target companies, we don't really know. But as you can see, it's this kind of companies fulfill fix the last mile problem. It's like when you order something online, you need somebody to deliver it to your doorstep, right? So these are the kind of companies which are very popular right now. And again, you can see that the Grab has listed in the US via a SPAC as well. So it's kind of like the same kind of team. If that is the team that's prevalent, then obviously big countries like Indonesia as well as India, not to even talk about China, so on and so forth. This is where that kind of companies have a very very large addressable market. Yeah. So in Indonesia, there Gojek and all that kind of companies as well. But then apart from that, you also have got things like fintech. So fintech is coming up everywhere. So even in Vietnam, Cambodia, so on and so forth. So as long as you have got a couple of really nerdy, eggheads coming together and say, hey, we're going to change the world and we're going to do this, that's also a possibility. Now, the main theme here is that the target company should be something that has a product or service that's very scalable, right? So I mean, if the sponsor eventually decides to buy a chain of 7-Eleven shops, that's that's not what we sign up for, because retail, you need to find a place, you need to rent it, you need to hire staff, so on and so forth. You need to think about supplies and frying the burger. Not really, the speed at which specs should be working at. So you want something that's extremely scalable. You can gain market share very quickly. You make a fraction of $1 every transaction, but you've got millions of transactions per day, and that's how this kind of company should operate. So that's what I think the kind of sectors I would prefer the spec to invest in.
Yes, Ben, thanks so much. Really insightful. Scalability, I hear you, that's really very important. And I think you touched on a point also, ASEAN, right, as a region. Obviously, over the next 10, 20 years, the rising consumption theme in ASEAN it's going to happen as, the middle class get richer and spend more. And I think the sponsors here do know that this is happening. And many of them have said that, look, companies with using technology to enable better lives. That's something that's they're looking for. Gerald, your viewpoint on that.
Okay, so I think the part around the digital economy, the more consumer-facing technologies have been talked about quite often. The other industry that I would like to draw people's attention to will be more on the industrial side. So some of the things that facilitate higher productivity, or things that reflect structural shifts in our economy. So one area would be, for example, if I were to look at renewable energy, that has definitely seen very high growth over the last few years, and potentially will continue to see that high growth. Some of this can be catalyzed by some of the geopolitical stuff that has been happening around us, as we think our dependence on oil, whether that will cause things like electric vehicles, solar energy, wind energy to start picking up. Even outside renewable energy, we are constantly thinking about how different companies can raise productivity. So that is where things like industrial automation actually comes in, as labor becomes more and more expensive. So I think those would be other interesting industries that some of these specs can be looking into as well.
Thank you, Gerald. That's very, very insightful. Yeah. Hopefully it gives us a little bit of a color in terms of what's important in this part of the world. Staying on with you, right? Really, I think you mentioned previously, specs as a trading instrument. Understand that in some of your sessions you shared a little bit about trading strategies around specs, especially now, right? Given that both warrants and shares are trading. Perhaps you can share with us, take some of your what you have been sharing previously. What are some of the ways we can trade specs, both from an existing shareholder standpoint and also potential shareholders? For example, if I were to look into trading specs right now, what kind of the trading strategies I should adopt? Yeah.
Sure. So on this front, I think we would need to understand what is our individual investment objectives, risk appetite, as well as time horizon before deciding what is the trading strategy that is most suited for us. So I will potentially name two examples at the opposite ends of the spectrum. For someone who might potentially have a very high risk appetite, we know that there are warrants that come with the specs. Typically, warrants are seen as being more leveraged compared to your stock. So that might be an instrument that is more suited for investors who have a higher risk appetite. In terms of the kind of protection mechanisms, there are less of these investor protection mechanisms that come with the warrants as well. So for example, some of the redemption features, the voting rights, are not available to warrant holders unless they were to exercise their right to convert to the shares. So that is another important consideration for someone who is thinking about buying a warrant compared to a common share. The other way to really think about this would be in terms of the risk reward. And that really ties in with the redemption feature that we discussed earlier. So if you were to think about some of the specs actually trading below their NAV, which is the effective amount of capital that is tied to the spec, and given the redemption feature where the holders of the spec share can potentially redeem their capital anytime before the completion of the business combination, then that effectively provides a strategy for investors to think about. Maybe the specs are not just an opportunity for me to be thinking about the upside that comes through from the acquisition that comes through eventually, but also it could be a good enough yield if I'm buying below the NAV and being able to redeem it subsequently at close to the NAV.
Hey, thanks, Gerald. That's very interesting. I guess yes, warrants one way looking at the NAV. In fact, I think some of the investors out there have been seeing this sort of like a zero coupon bond, for example. I think what would be interesting also is about how people value company warrants, because that's obviously a very, very different set of valuations versus normal securities. Benjamin, your thoughts on the trading strategies?
So it can be, I guess, as exotic as you want it to be. So a warrant is basically a call option, right? So there's always a relationship between the value of a call option and the underlying security. So in this case, the spec IPO shares. So if let's say the equilibrium is not there and the spread is too wide, then you can always, for example, buy the call option and then short the underlying stock, or the other way around. It depends on how far away the spread is. So that is also possible. And again, as Gerald has mentioned, if the spec IPO shares drop to $1 and then you can buy it for $1, you can go and redeem it back for $5. As they say in French, 包价one. So it depends on how exotic you want it to be, or you can simply just buy and sell. Because both the stock as well as the warrants are now detached and they are tradable separately, so you can always buy low, sell high. Yeah. The challenge with, of course, the buy low, sell high is that there are no fundamentals, so it's basically just all sentiment, right? But there are various ways, so it depends on how creative you want it to be.
Right. Thanks both. That's very helpful for us. Obviously, with trading specs, right? Something that I think from our perspective, we are also very mindful about risk. Spec, I think they are like securities. They do have certain securities risks, right? There are also spec-specific risks. Staying on with you first, perhaps, Ben, you can highlight a few important ones which you think retail investors should really pay attention to in terms of the key risks for specs.
So there are a couple of things. So before the de-spec process, one of the key risks is, of course, the credibility and competence of the sponsor, because that is the so-called management team that's going to help us identify a good target company, do the paperwork, the process of bringing it to public, acquiring the target company, and of course, and again, after we acquire the target company, hopefully the share price goes up. So that's more like the competency and execution part. And now the other part, which is I guess maybe a bit overlooked by retail investors out there, is that after the de-spec process, okay, yeah, hi, this is great, the sponsor has bought a very good company, but guess what? They bought a company which is in a particular sector, maybe clean energy, and I don't understand clean energy, and maybe incompatible with my risk profile, incompatible with my investment horizon, and I don't understand it. So that is the other part, right? So because at this point in time, we have no idea what the spec sponsors looking at. Eventually the target company might be something that we don't actually want in our portfolio. Yeah. So that's the other part of it. We might be looking for something that it's comfortable. The next Ninja van, that'll be quite interesting, and then they buy something else. Okay, so you might get a little bit of a buyer's remorse there, but I guess the great thing is that before that, there are various off-ramps, and even after the de-SPAC process has gone by, you can always sell your shares in the open market. And not to forget, there are the warrants as well. Okay, so there are various ways to get out of position, for retail investors.
Thanks for sharing, Ben. Gerald, from your end, some of the risks that you think should be highlighted.
Sure. So on my end, I'll highlight two risks. One is the liquidation risk, which is really if at the end of the period where the sponsor is supposed to find a target, but is not able to do so, then what happens to the SPAC at the end of the day? We might actually have very high hopes that they'll be able to acquire something. In some cases, not only is it not to our expectations, but they might not even be able to find a target at the end of the required period. So that is where the analysis of the sponsors become very important, because going back to the points that we discussed earlier about understanding their understanding of the industry, whether they have the right networks in the industry to be able to make the right acquisition, that will effectively help to reduce the risk around them not being able to find a target by the end of the required period. The second risk is something that is called dilution risk, because there are different investors that can potentially come in at different parts of the SPAC life cycle. So when we come in at the IPO, we'll put in some capital and this is locked into the escrow account. But when the sponsors actually decide to find a target to acquire, then we are thinking about other investors that will come in as well. Some of these are called pipe investors, or effectively third-party money that comes in to also fund the acquisition. We also have the investors from the target company that will also come in when these two companies combine. So as we think about the different investors that will come in at different phases, we also need to take into consideration how much our existing holding of the SPAC will be diluted when they eventually combine with another company.
Thanks both. That's very helpful for us. I think I'd summarize it as sponsor risk, definitely something to look out for, liquidation risk, and also dilution risk. So those are really, for you investor, if you're looking to invest in SPACs, right? 3 key risks, in addition to securities risk, you should be looking at. Yeah, right. So on that note, I think, Gerald, you mentioned about pipe investors. So I thought it's a good time to ask you on that. How important a role do pipe investors play when it comes to the SPAC? And perhaps you can just share a little bit from that perspective. At least in US, right, you see quite a lot of tier 1 pipe investors coming in. And I think from a investor perspective, you sort of have a little bit of a comfort that you have these brand names, but we'd love to hear your thoughts on the role they play.
Sure. So I guess as investors, we want as many people to be involved in analyzing the target company as possible. So apart from us doing the work around analyzing the company's fundamentals, if others are contributing and helping to do the due diligence, then collectively we might be able to decide whether the company is good, whether it has got long-term growth prospects, whether the valuation that we are coming in at to acquire the company is attractive. So that is where the pipe investors can potentially come in, because they are also investors who are looking at the SPAC and also the target company to see whether the deal makes sense or not. So when they actually come in, they will also be doing the analysis around the target company as well as the valuation. And we can potentially rely on their expertise, their professional analytical framework to be able to decide whether this is a target company that is good as an acquisition target. So it's not different from, say, having the cornerstone investors that might come in from an IPO process. where effectively when some of this due diligence is done, effectively we have got this collective ability to understand whether it is a good quality company.
Yes, thanks, Gerald. Essentially, I think the more professional investors who sort of like, if you will, right, done their homework, I think that really gives a level of comfort, right? I think to add also in Singapore's context, right, for the de-SPAC or business combination, if there is pipe funding, pipe financing, right? Apologies for that. There is no need for the sponsor to seek a independent valuer for the assets or the business that they're going to acquire. So this is something that I just want to highlight to people over here. Benjamin, on pipe investors, any different views that you may have? We'll be interested to hear some of them.
Different? No, I mean, totally agree with what Gerald has mentioned. From a slightly different angle, just to rephrase it, having a pipe investor is something like, having very good quality anchor investors from the beginning. If you look at again, using a very local example, if you look at a, shopping center in Singapore, you need to have three things. You need to have a supermarket, you need to have a food court, and you need to have a golden village. That's kind of like the three things that you must have. And if you look at some of the very small neighborhood shopping centers, they may not have a golden village, and they have got the other two, but people really don't go there to stroll around on a Saturday. They basically go there buy groceries. So if you have a what you call a SPAC that has got really good, well-known anchor investors as well as pipe investors coming in, from optics perspective, at least from a reputational perspective, it kind of illustrates the attractiveness of the SPAC, that all these good quality investors, these serious investors, professional investors, have got a certain level of comfort in the sponsor. Okay, so that's good. All right. Of course, the flip side is that if you have got a whole bunch of anchor investors and pipe investors coming in, then the retail tranche could be relatively small. So there's the flip side. All right. Okay.
Hey, thanks, Ben. I really like your analogy there. With all the different options, or rather the segments coming in, that may potentially be more feasible for the investors. Thanks for that. I think, I think looking forward, right, we've all know that SPACs have a very distinctive life cycle and all. In fact, I think we've all mentioned that detachment has happened. We are now all eagerly waiting for the de-SPAC, or the announcement of the initial business combination, if you will. That's another name for it in Singapore. Perhaps Gerald, you can share a little bit about this whole process, right? What should investors expect, particularly around the process, around the de-SPAC process, when they announce their acquisition? Bear with me. And one more would be perhaps the stock price, right, of the SPACs and the warrants, right? How would they potentially react to the announcement and all? Yeah, I think that would be quite helpful for the listeners.
Sure. So prior to the de-SPAC process, we really know not too much about what is the target company that will come through. So that goes back to the earlier point about all the information is really around the sponsor and how much we trust the sponsor to be able to find a good quality company to acquire. I think the de-SPAC phase is effectively when we will have a lot more details about what is this target company, whether it fits within our initial expectations around it being a high growth company with very good prospects in the long term, and also the valuation that this company is going to be acquired at. So in that case, how we would look at the de-SPAC process wouldn't be too different from how we would typically analyze a stock when deciding whether to buy or sell it. So it would be looking at, say, whether the company has got good fundamentals, it has got a business model that has been able to generate very good profitability in the long term. In the industry that it operates in, it has a very strong competitive edge and doesn't face very significant disruptive pressure. When we look at the financials of the company, it has got good profit, it generates good cash flow, it doesn't have a very high level of debt. And lastly, in terms of valuation, we are not overpaying for this target. So all of this we can potentially analyze when we actually find out more details about this company at the de-SPAC stage, as well as the valuation that this company is going to be acquired at.
Thanks, Gerald. Yeah, Benjamin, perhaps some thoughts from your end.
Sure. So it might sound like there's a lot of work and expertise required to kind of analyze the target company. I would say that I'm confident that the investing community, the banks and the brokers will eventually write research reports on all these target companies that the specs are looking at. So don't worry too much if on one hand we say you need to understand the sponsor, then after that you need to figure out whether the sector they're investing in is attractive, then after you need to think about your portfolio, then after you need to think about the valuation and price. I'm quite confident that there will be research reports available, so you don't have to crunch the numbers. You can read the investment thesis and see whether or not it suits you. Okay. So apart from that, the mechanics of valuing I guess a target company is no different from, as Gerald mentioned, an M&A exercise, or it's basically just the usual. What's the business cash flows and what kind of what you call the cost of equity you want to apply. So that's kind of standard methodology that the research analysts are currently using. So nothing too exotic.
Great, thanks. We'll certainly look forward to more investment reports. Obviously, they'll be able to help us summarize some of the key pieces and also valuations, right, if you will. I guess not many of us do have the patience to read 500-600 pages of prospectus. Yeah. Yes, I think, I've got a couple of questions. We've got 10 minutes left. I think at this point, to people who are viewing this session right now, there's a really small box, actually not very small, on the right box, right? There's a Q&A. So please, while we have the experts here, just key in your questions. There are number here. I'll just pick it on. Maybe just want to hear your thoughts, right? This top rated one is, what is your top pick from the 3 specs in SGX, given that there is almost nothing on the financials to analyze and compare? Yeah, so no, Gerald, you want to take this one?
Yes, Gerald should take this one first.
Okay, so I think if you have looked at the framework that we have been trying to steer the discussion towards, a lot of it at this point in time is really trying to understand the sponsor. So I think even amongst the 3 specs that we have seen being listed in the Singapore market, there are differences in terms of the sponsor track record, in terms of their existing portfolio of assets, whether they have actually the right skill sets to be able to acquire another company that we want to be investing for the long term. So I think that is effectively what we have been trying to suggest through this session, and what we can actually look at to decide what actually is our topic. So in this case, really look at the sponsor, whether it has effectively something that is aligned with our interest as a retail investor. So in this case, thankfully, in terms of meeting the amount of capital to be put into the escrow account, we have seen the commitment by the specs. Thereafter, it is really about whether we believe that the sponsor is actually having the right domain knowledge. Some might be more familiar with the ASEAN ecosystem that they're looking to acquire from. Some might actually claim that they have a very strong network of contacts, maybe not in Singapore, but outside of Singapore, closer to Europe, in which they are able to leverage their brand name to be able to make an acquisition. We just need to think which one do we believe more in, which one is more aligned with our long-term fundamental belief in a sector that we want to be invested in, and then making a decision from there.
Yeah, thanks for that. Benjamin, anything from your side? If not, I can move on to the next question.
Sure. So I just want to preface my response by saying that SIAS is not an MAS licensed entity, so we are a registered charity. So hence, I was saying that Gerald should answer this first. And also in the interest of full disclosure, I as well as some of my family members have invested in some of these specs. So now with that aside, I would say that so the 3 specs are already currently trading, right? And as you can see, some are doing better than others. Okay, so don't take it as if the current price for a particular spec is above $5 IPO price, and therefore it is good. Some are trading at a discount, that's why it's bad. Nothing of that sort. Simply because it is just down to market volatility, right? So all these are cash companies. They have got no businesses, nothing like that. Now, I think one of the specs, and I'm going to talk about VTech here, is I guess people are more comfortable with that spec simply because the management team, the sponsor, is a homegrown company. We do know what they've been doing. They've been around for a long time. But again, that is not an indication of how well the spec process will go and the attractiveness of the target company. So really, it's hard to have a pick simply because in my opinion, and again, I'm not licensed to make a recommendation, but in my opinion, is that all of them are actually well run. It's just that VTech is more popular simply because we know the company, the people behind it, right? But the rest also have got really good track records and they're professional, serious people. All right. So until we know what the target company is actually just 1 out of 3, and I just take a dart and you just throw. I don't know.
Thanks for that, gentlemen. I think as mentioned, the track record, executional track record of the sponsor, obviously that's very important with the absence of any de-spec announcement. So as articulated earlier on in this panel, that's something I think both speakers have really emphasized about. Thank you. I think there are a couple more questions streaming in now. Okay, maybe I'll just start with this one, right? Would you recommend investing in specs to beginner investors? Why and why not? I'll just open this up. Anyone will just feel free to jump in.
Okay, maybe I'll just take a step. So if you're an absolute beginner, possibly you should just invest in the ETF, exchange traded fund, or really something easy to understand and quite boring. For example, REITs, the S-REITs ETF, right? So diversification built in, there's no FX risk, so on and so forth. Specs, it's a different ball game, right? So you really need to read the prospectus and understand the mechanics. Okay.
Yeah, so I agree with Ben on that. Given our discussion earlier, there are a lot of complexities around spec. This can be around the protection mechanisms. It can be around the different trading strategies. It can be understanding what is a warrant, what is the shares. It can be understanding the time period in which it has the detachment option. So I think given the complexity around all of this, it takes time to understand. For those who have the interest, it is good to refer to different educational materials. But until you understand the mechanisms that come along with it, the risks that come through with different trading strategies, then I would suggest that maybe it might be better looking at other asset classes until you truly understand the risk as well as the characteristics of specs.
Yes, thank you. To add on, obviously from our team, investor education is of utmost importance, especially when it comes to specs, right? So in addition to materials you can read on SIAS webpage, in fact, even Gerald's webpage, beansprout.sg, right? SGX, we would like to think was one of the most comprehensive product information page out there on specs, www.sgx.com/SPAC spec. So that's something that you guys can take note of and perhaps learn some things on the product. I think we're running a little bit short of time. Perhaps one more question from the floor, and then we'll get the gentleman to wrap up a summary. So the question is, what ROI percentage should we expect for specs? I think the first part of the question was about how should we review the 3 specs. that we are currently in the market. I think we've discussed that already. So the second part of the questions, any insights about it?
Okay, so from our point of view, what is important is not just to think about the ROI, but actually in thinking about any investment is about the risk reward. So we are not just thinking about the returns that comes through, but also the risk that comes along with it. So I think in terms of a SPAC framework, this is particularly helpful because you have the protection mechanism around redemption that allows us to better think about the risk reward as well. So if you are potentially buying a SPAC at 480, the redemption feature, which potentially allows you to redeem at close to $5, that effectively means that in terms of the risk reward, that would be more, or at least it would be better compared to if you are buying in the SPAC at $7, with the hope that you are able to buy into a SPAC that's able to acquire a very high growth company. So that might be a useful way to think about your risk reward compared to just thinking of it from a ROI perspective.
All right, thanks. Yeah, thanks so much, Gerald. Interest of time, perhaps to wrap it up, first, Benjamin, a crystal ball question, right? Small unicorns are created regionally, potentially looking to seek public monies and all. Yeah, what are your views that the SPAC ecosystem will evolve in this part of the world?
I guess SPACs are basically new in Singapore as well as Hong Kong. They just started as well. But I think eventually over time, people will accept it as a viable investment vehicle. People will get used to it. And after seeing the track record of the first few that we already have now, then people might come to the conclusion that it is just another tool in the toolkit, right? So you've got bonds, you've got REITs, you've got stocks, and you got SPACs. After a while, I think people will just accept it as part and parcel of their normal investing strategy.
Thank you, Ben. Gerald, perhaps you would like to sum it up.
Yeah, so agree that we are at a very early stage in the entire SPAC listing process in Singapore. We have only just seen the detachment coming through, but I think what all of us are eagerly anticipating will be the de-SPAC process and to really understand what are the attractiveness of the companies that these SPACs are able to acquire. But in the meantime, it is great that we are having this discussion, trying to get more people to understand what SPACs are, because all of that would effectively allow us to have a better ecosystem, not just on the sponsor side, but also on the investor side. And I think that can only grow with time.
Hey, thanks so much, gentlemen, for your time. Sorry we exceeded a little bit, but ladies and gentlemen, Mr. Benjamin Goh, Head of Research and Investor Education at SIAS, Mr. Gerald Wong, Founder and CEO of Beansprout, Singapore. So with that, I think Lionel here, we are signing out. Do feel free to join in the other sessions, and I would like to hand it over to the main floor. Edward, over to you. Thank you.
Thanks, Lionel, and thank you also to our panelists again, Mr. Gerald Wong and Mr. Benjamin Goh. Coming up this afternoon, we'll be talking trading themes, asset classes, creating a trading system for yourself, REITs, portfolio building, sustainable investing, semiconductors, and an investing strategy for Asia. We also will have a session in Mandarin, and also for the first time, there will be a session in Cantonese. You don't want to miss these. We start again at 12:30 p.m. In the meantime, please do check out our exhibitor hall for exclusive content and promotions put together by our sponsors and participating brokers. Head on over to the main lobby, click on those arrows on the bottom left. In the meantime, enjoy your lunch. We'll see you again at 12:30 p.m.